Welcome to this Killik Explains finance video. This week, a topical one, the pros and cons of robo-investing. Now, I can't stand that title myself, but it's the one that's commonly used. So let's take a look. The big debate, as it's sometimes pitched, is this. In the media, you'll see people saying apps are the future because an increasingly number of people want to do DIY investing. In other words, they want to do it themselves, take control, and apps give them the ability to do that. All right, most of these things offer automated, regular investing. So your money can be sort of dripped in, or you can put little lump sums in if you like. It's easy, fast, and cheap. Most are relatively straightforward to use, and minimums are low. In other words, you can invest a relatively small amount, tiny amount potentially, each week or month or whatever it happens to be. Now, on the other side, if you like, of the ring, you've got more traditional investment advisors or full-service advisors, qualified professionals offering tailored investment advice. Now, what your money's invested in can vary, but you've got portfolios being managed for you. Those can be fund-based, direct equity-based, bond-based, or a mixture of all of those potentially. Charges will tend to be higher where you've got advice and or discretionary management going on, and there may be account minimums to access certain services based around regulation and so on. But is it really one or the other, or the future and the past? I'm not sure it's that simple. Why not? Well, basically, it all comes down to what you think investors want. Now, you know what you want, but actually some quite big brains out there have looked at this, and one of them, David Stevenson, has come up with what I call a hierarchy of needs. In other words, it doesn't matter which way you're going to decide to allocate your money or where you're going to put it, app, human advisor, what do you actually want at the end of the day? And number one is financial performance and returns. In other words, I've been guilty in the past of going, I'm going to go for the cheapest fund I can. I put my money in there, it's turned out to be a dog for 4 or 5 years in a row, complete waste of time. Cheap is not always cheerful. Number two, protection from capital losses. People want some reassurance that if markets take a downturn, and who knows, if you believe the Jeremy Grantham melt-up theory, they could do at any moment, people want to know that they've got a degree of comfort and protection. Number three, contact with a professional. That is still rated, particularly where you want a broader range of services potentially than a simple robot solution might be able to offer. A reliable, trusted brand. Clearly, if you're about to hand your money over, you need to know who you're handing it over to and what is their background. Why would you hand their money over to them, whether they're offering a robot solution or some other way of managing your money? And then last, but not least, but definitely last, technology and UX, user experience. Now, fintech firms will be screaming, no, that's number one, but actually it isn't. Clever solutions are not always the best solutions, and it's worth bearing in mind that this pyramid, this hierarchy does work sort of in that direction, hence the size of the fonts. Okay, so let's keep that at the back of our minds and go through some of the sort of pros and cons. How the battle line's being drawn, if you like, between robot and human. So returns do matter. Now, you can basically make a choice based on what I'm about to say. So typically apps will allocate your money to a range of passive funds. The way these things generally work is they will look at, using some fairly straightforward questions, your risk profile, so basically low, medium, highs, what kind of person are you, and then they'll attempt to allocate your money to a kind of standard bucket built up of a series of funds. And those funds will tend to be what's called passive. They track stuff. All right? So basically the idea is they allocate your money to a range of typically passive funds, because those tend to be lower cost in the first place, based around risk categorizations. They need to sort of find out some stuff about you first, and the underlying funds may be in-house or external. Now, it depends on who is offering the app, if you like. So if it's an existing wealth manager, for argument's sake, then they may or may not have in-house funds they can allocate your money to. If it's an external, fintech-style independent, then clearly they won't have any in-house funds. Your money, almost by definition, is going somewhere else. But, so this all sounds great so far. Many app providers have little or no performance track record. Now, the ones that are independent, the fintechs, for example, they sound great. They offer great platforms in some cases, but their track record in investing is relatively slight, even non-existent in a few cases, and there may be no way through them to invest tactically and limit your downside exposure. Now, some people would say in a rising market, who cares? But actually that's the whole point. Markets don't go on rising in a straight line forever. More of that in a moment. You may have limited control over asset allocation and fund choice. Again, in a bull market, some people would go, don't really care, but actually it does matter. Now, to take a look at that very quickly, there's the S&P 500 going up more or less in a straight-ish sort of line for 10 years. And if you're a Grantham melt-up theory enthusiast, you'll notice that it's got a bit steeper recently. So everyone's asking the question, what next? But even if we don't know what next, if we're looking back here, tracking that index is fine, but there's no strategic or tactical sector allocation. So a few people have spotted the opportunity to ride the back of what's been a recent tech bubble or boom, for example. Then there's geographic exposure. As a UK investor, all right, do you want to take advantage of the fact that sterling's been relatively weak recently? Other currencies have been quite a bit stronger. Then there's growth versus quality. A few people have noticed, including Grantham, that recently and unusually, quality stocks have put on a bit of a surge. Following a benchmark, there's no way you can realistically take much advantage of that. And finally, there's downside risk. And this even presupposes you know through an app what's under the bonnet. You even know actually where your money is being allocated. So there's a visibility issue too. Now, a human shoulder to lean on. So this is the other side of it. What a lot of people rate quite clearly is the ability to protect themselves from capital losses. You've built up hard-earned money, you're prepared to put it to work, you're prepared to take a bit of risk, but you don't want to lose it all. So, apps, yes, they can achieve low-cost exposure to a rising market. They offer automatic diversification, so they take away that single stock risk, if you like, and that's important. They're often cheaper than full-service alternatives, and costs do matter. Anyone who says costs are the only thing that matters, well, that's, I think, pretty clearly not true, but they are important. All right, performance matters to most people. That blend with costs is the key, if you like, and you don't need anyone to talk to. Now, for some people, that's an advantage. They like the fact they haven't got to pick up the phone or go and visit anybody in order to use an app. But this is generally better in a rising market than a tougher market. In tough markets, people want help and advice. In tough life situations, people generally want help and advice. And apps won't protect you from our all too human frailties, from which I suffer as well, by the way. The temptation to panic sell as markets fall, bang, hit the button, it's done. Overtrading, that's hitting the button too many times, and trying to time the market, hitting the button whenever you think you've got ahead of the rest of the pack. And all these things are quite straightforward with a robo-investing solution. So a one-size-fits-all approach to the bottom just says basically the other problem is that these things do attempt to allocate you a kind of broad risk-based investment strategy, but we're all individuals, okay? So be aware you're being sort of categorized on basically a little bit of a one-size-fits-all basis. Now, user experience and technology. Yes, technology is exciting. These things offer portability and access. They may come with a range of sexy-looking training and support tools, charts everywhere and so on. May allow you to manage data on screen, configure it in different ways that suit you, and so on. And all of that, to a certain kind of person, is quite attractive, but by no means to everybody, all right? And quite a few of these things have actually broken the one rule you think they follow, which is to keep it simple, stupid. Being bombarded with charts has been shown not to encourage investors to think they know how to invest, if you like. Connectivity risk is something you've got to watch with all apps. Costs do vary, all right? Surprisingly so, actually. So be careful of just assuming these things are all similar in cost terms. Do a bit of digging. Find out what's under the bonnet, at least in terms of what you're being charged. And the quality and the amount of user support, I have to say, does vary from very good to not very good at all. And that's worth bearing in mind as you make your selection. Now, in summary, therefore, is this a sort of split black and white decision? No, it isn't. I think there's a place for both. Saving apps, brilliant, where you're looking at relatively small amounts being saved on a regular basis. Why not make it a sort of lock up and leave solution, as long as you do leave the money and don't sort of tinker too much. There's a high convenience factor. All right, the technology can be quite sexy and attractive. Costs do matter, they are important, and apps do their best to keep them low. And therefore, for people looking for a relatively straightforward option, yes, there's a place for these things. But when you want a much broader view of your assets, aspirations, and personal preferences, an app is going to fall some way short. All right, they don't really know how to mitigate what I call human error and downside risk, okay? And if you're looking for a much broader range of solutions and products, all right, so if you want to move way beyond just pure day-to-day investing to estate planning solutions, tax-efficient solutions, and so on, once again, there's a limit to where robo-investing can take you. Okay, so my conclusion, investing apps, evolution rather than revolution. In other words, these things are great as long as you trust the brand, as long as you know how they work, and as long as you know where to sort of fit them in to a broader investment strategy, fantastic. But I don't think, for all investors, they are the be-all and end-all. Any questions? editor@killik.com. And if you'd like to watch videos on some of the topics I mentioned as we went through this one, then killik.com/learn.